This morning, we got some really interesting news out of the US. US job cuts surge, and it's not for the first time either. Check it out. US based employers announced 89.7 thousand job cuts in March, 319% above the 21.387K a year earlier, as higher interest rates are forcing companies to cut costs. A simple concept about this is that if rates are higher and companies that have debt are forced to dig deeper into their profits, sometimes that means cutting labor that is uncompletely necessary to the company. Things that are not vital to the company running are oftentimes the first things to go. It was the third time this year that cuts were higher than the corresponding month a year earlier. Considering Q1, employers announced 270,000 plus job cuts, the highest first quarter total since 2020, led by, of course, the tech sector, one of the wildest, most volatile components to markets. In other news, we also got some CAD employment numbers that came out. So you can see we actually had a beat, and maybe we'll take a quick look at the Canadian dollar in just a second. But we actually had higher than expected employment change, meaning more jobs, and unemployment rate actually decreased from the 5.1% that was expected. We actually came in only at 5%. And again, here's a look at the unemployment claims, which were higher, which is worse than expected in terms of jobs from the 200K that was forecasted. Let's have a look at the charts and see how the markets are reacting. So first, let's have a look at the Canadian dollar, which is an interesting chart to take a look at right now. Here's the CAD yen. So the Canadian dollar spiked higher on all of this news. Again, hotter than expected, better than expected unemployment numbers and employment numbers in Canada, causing the Canadian dollar to push higher. Now, I'll talk about whether or not I think that this is to last or not in just a second when we have a look at the COT data. But again, why would this cause such a spike? Well, the reality is that the Canadian dollar has been pretty bearish in terms of market sentiment. The CAD Japanese yen has had a pretty steep decline recently with a little bit of a push overall, but you can see the long-term chart off of the daily and weekly has been really negative for the Canadian dollar, especially against the Japanese yen. So even on good news today, we see a justified move higher, but the question is this actually going to last? And I'll give you a quick take on the CAD real quick. If we take a look at the smart money tracker, there's a red flag here. The Canadian dollar is very heavily short according to institutional data. Now, how do I have this data? Well, we're tracking the COT report. We take the COT report, which is this messy, giant block of text, and we have dug through that data and built a clean, easy to look at software tool that allows traders to take a look at the COT reports. And you can see right now, when talking about the Canadian dollar specifically, we have a whopping 80% of the futures contracts traded on the Canadian dollar COT non-commercials data is on the short side, just a little under 80%. That shows clear preference for shorting the CAD right now. So as we rally today, in my personal opinion, I'm not super convinced that I want to be long Canadian dollars at this time. So if we take a look at something like, for example, Euro CAD, which is overall in a nice downward trend, if we do start to see the Canadian dollar strengthen, meaning, again, this chart sort of comes down, I think that there actually is an argument for more bullishness on this chart than anything else. So where we currently sit, we are just above a strong level of demand where we saw, potential strength here. So in terms of the CAD, I'm not necessarily super interested in buying it, and in fact view this as a possible short opportunity on some Canadian crosses against stronger currencies. Anyways, let's take a look at what else was moved by this market. We have, by the news this morning, we had the gold market actually come down here on the news. And I'm going to be honest with you, this is a little bit weird for me. I'm still trying to interpret this. Jobs numbers, again, we'll go back in terms of the US specific numbers. We had from the US, we had jobs numbers, unemployment claims higher than expected. That sounds like uncertainty, that sounds like fear, that sounds like layoffs, that sort of thing. So why is the gold market selling off? What we know about gold is that gold tends to rise in a fear environment where layoffs and unemployment fears are rising. Oftentimes that's a positive correlation to gold. So in my personal opinion, today's price action actually looks like a dip buying opportunity on the gold market. We'll take a look at the Edge Finder's view of gold really quick. I'll show you this. Let me move my camera down to the left just a little bit. If we take a look at the gold market here on the COT data, gold is still the heavy favorite. The big heavyweight champ right now is the gold market, which is currently sitting at a whopping 79.4% long ratio in terms of futures contracts to the long side. You can pause the video if you want to take a look at the specifics. Long contracts heavily outweigh short contracts. We've talked about that in recent videos here. So yeah, I mean, to me, I still look to be long gold, and a retest of 2000 actually looks pretty attractive. Let's take a look at retail sentiment, see if things have changed here. We'll include commodities on the list so that we can take a look at gold. And you can see gold here, the ratio is still heavily in favor of the short side. Now, when I say in favor, what I mean is that retail traders are piling into short trades on the gold market. Why does that matter? Well, when it comes to the crowd, and I'm talking the amateur crowd, the crowd that tends to lose money, right? We know 95% of traders tend to lose money. If they're all in shorts, I actually prefer the long side of the trade. So this adds extra confirmation for me to look for potential buy trading setups on the gold market. If you're interested in getting access to this data, we are currently doing a massive discount sale on the Edge Finder. And if you'd like access to our data, which includes retail sentiment, smart money tracker, all of our economic figures, GDP, inflation interpreted for you to make more easy to understand and add insights to your trading. If you'd like access to this data, we've been working on it for 1 full year, and we are celebrating by offering a massive 40% off discount sale. In the link down below in the description at the very top, you'll see a link to chat with one of our team members. If you click chat now and you click tell me about your discounts, for a limited period of time, if you chat with a support representative, you are going to get the biggest discount ever on the Edge Finder. And again, all you have to do is click that link at the top of the description, click tell me about your discounts, and one of our support reps who is here in office as part of the team that is building this software, one of our support reps will get you access to the Edge Finder. They'll set you up with training with the Edge Finder so that you can go through it and make sure that you fully understand, answer any of your questions that you have. And again, if you message them, you'll get an even bigger discount than the 40% off that we are offering on my channel right now. If you use code YTVIP, you can just skip that process and get access. The link will be down below in the description. But if you want to chat with us and ask a couple questions about it, all of the information can be found. Just click the link, hit tell me about your discounts, and one of our support reps will get you set up. Now, in terms of retail sentiment, let's see if there's anything else of interest here today. If we take a look, for example, at the pound, I mentioned this in my live stream today. The pound USD has benefited, especially similar to gold, from the recent slight dovishness from the Federal Reserve, right? The Federal Reserve this year was forecasting several rate hikes. I think at one point the forecast or the expected amount was 5 rate hikes in 2023. Now we're forecasting much less than that. And even now the projections or the money markets are sort of forecasting rate cuts perhaps by the end of the year. And at the very least, no more rate hikes starting in summer. Now, again, we can take a look at that by taking a look at something like the US 10-year, which is showing yields have declined massively. Now, if you're not familiar with yields, the bond market is a very, very important market. It has a lot of correlation to what's going on in the interest rate forecasts. So what you can see is that on the 10-year, at one point we were at 4.3%. The money market's expecting more and more rate hikes. Since the turn of the year, however, the market or the yield curve has really, or the yield expectations have come down a lot. The interest rate forecasts have become increasingly dovish, and this is causing the US 10-year, the US 20-year to come down pretty tremendously. In fact, let's take a look at the bond market. You can see here is a close-up view. Maybe we'll zoom in on the edit. You can see we've got the US 30. Here, actually, let me add something really quick. You can see that in terms of the symbol, we've got US 30 year, the 20 year, the 10 year, and we can see the latest in terms of the yields offered. So right now, the US 30 year is offering 3.5%, US 20, 3.6%, US 10, 3.3%, let's call it. These are down pretty tremendously from the highs. And why does this matter? Well, it's one of the driving forces why the dollar is selling off so strong. yields are falling, bonds are rising, and with that, the dollar is becoming sort of less attractive in that sense. So, and why is that? Well, again, it's because forecasts for rate hikes are declining. There are expected to be less rate hikes now than there was at the beginning of the year, which of course is doing a lot to the markets. Gold is appreciating because of that. The S&P 500 has risen because of that. The dollar has fallen because of that. We're seeing sort of a normalization in markets due to it. And it's a very interesting story that I'll continue to cover here for you on the channel. Remember, guys, you can get access to the Edge Finder or our Discord channel using the links down below in the description. There's plenty of good free stuff there, as well as our products and services that are available on our website, a1trading.com. Thanks for watching. Hey, guess what? I just found a video made just for you. Click this video to help with your trading, and thanks for watching.